Hey there, everyone. Ryan Schul at Straight Data Science. So, in the topic today, I want to talk about how we can predict potential loan defaults and then adjust credit risk scoring accordingly, right? So, I worked in the banking sector for a long time, been on Wall Street for about 22 years. So, I think this topic is very interesting. I've done this kind of work before, and I want to introduce you to it. And I've tried to make the problem kind of generic and the solution specific to solve the problem. But I tried to make it kind of generic initially, just so you can take this code and adapt it to your own personal use case, right? If you need to do this kind of thing. So why would we even do um, like loan default analysis, right? Well, there's a couple of pretty big reasons, right? That's what took down Lehman Brothers. That's what took down uh, Bear Stearns, right, in 2008 or 2009, like 2008 financial crisis, right? So these are very sensitive topics that if you don't understand what's going on, and fundamentally the people, I think, kind of knew, they didn't really understand. I think there was a lot of greed involved too. They thought just a little more, just squeeze a little bit more, just a little bit more, we can get another couple 10 million, maybe 20 million out of these transactions. I think there was some greed involved, but fundamentally, I don't think a lot of people really understood what was going on, and that was very unfortunate. So let me introduce you to the topic. And it does get complex. I'm not saying like Bear Stearns was clueless and Lehman was uh, a bunch of morons working there. I'm not saying that at all, but I think a lot of people fundamentally did not know what was going on, and that caused the downfall of these juggernauts, right? So anyway, so this is very important because it protects against financial loss. It improves risk-based pricing, right? Risk is a huge element in the financial world. It helps us understand regulatory compliance and capital planning, right? I've got a couple of videos about that. If you're interested in that, please check it out. It enables early intervention, right? Like if Lehman and Bear got involved earlier or really engaged earlier, they could have prevented the collapse of these behemoths. They really didn't, right? Either they didn't care or they didn't know. I think it was just a small part, but I think it was mostly driven by greed. Let's let's not be greedy, right? In the Bible, it tells us if you're greedy, mm, you're going to be destroyed, right? That's exactly what happened. So it was unfortunate, but it was kind of hilarious too at the same time. Portfolio level risk management, that's a very important topic, right? Personalized credit decisions, builds better machine learning models, right? Garbage in, garbage out. If you have good, clean data, you can do a very interesting analysis and understand what's going to happen next and make predictions into the future, right? I've got several videos about that. And you can integrate macroeconomic factors. Micro is small, macro is big, right? You can integrate lots of different factors and understand the big picture and really understand what's going on with your bank, with your lending institution, with your financial enterprise, with your whole financial ecosystem, right? So I think that's important, and really for fintech and any kind of digital lending, that's very hot nowadays. So I think it's important from that perspective too. So let's jump into it. So I put together some code here. We have credit scores, debt to income ratio, typical things, right? Loan amount, unemployment rate, GDP growth, and interest rate. So we have some macro factors here and some very specific client specific features as well. So let me go ahead and run this. I'm going to create a data frame. Control Enter to run it, create the data frame, and let's take a look and see what this thing gives us, okay? Okay, so we have the credit score, the debt to income ratio, loan amount, and so on and so forth. You can read it for yourself. So this is important. This is going to give us or help us understand credit scores, debt to income, loan amount. How much can we loan to this enterprise or this institution? Are we going to get the money back? Is the loan backed up by some type of asset? Is it asset backed collateral, right? So this is going to help us understand all these different features and factors. If somebody puts up an asset, I can loan them more money, right? Because it's backed up by the asset. If they don't repay the loan, I can claim the asset and I can sell the asset, right? So it's good. I can loan more money or larger amounts to a borrower, right? If there's no asset behind the loan, then I probably won't be as comfortable to give the loan, right? And I will be more hesitant to make these big transactions, right? Because it's not backed up by anything, right? So we have to be aware of that too. So let's go ahead and set up our first machine learning model right here. I am going to use let me see, this is a classifier. Yep. Okay. So I did this 1 or 2 days ago. I put together like 9 videos all in the span of 2 or 3 days. So I have to get oriented here on what this is doing. So this is a classification report. So I'm trying to determine, is the loan going to be paid off? Yes or no? It's just a binary thing, right? So true or false, yes or no, 0 or 1. That's all we're trying to predict here. And we can see with this model that I just set up here, and I've got several videos about machine learning models and about data science. So if you're really into that, go check out those other videos. I'm not going to get into all like the whole backstory. It gets very complicated and it's very drawn out. And I don't like to repeat myself and create redundancies and things like this, right? But this is a classifier right here. And we can see the precision, recall, and the F1 score are all ones, right? So 1 is good, higher is better. The recall for the default is 0.25. Precision is 1. Default is 0.225 and 0.40 for that. So that's a little bit lower, but that's still okay. The AUC, area under the curve, is 0.99. So that's pretty high. So I'm pretty confident that this model has been trained and tested and can make predictions, right, into the future. So that's the whole point of machine learning. You want to set up the model. You want to have good, clean data, first of all. Set up the features, make your prediction. If you look close right here, the prediction, will there be a default? That's why I'm interested here. You can predict anything, right? But you have to kind of like say to yourself, does it make sense? Like, what are we trying to predict? Are we trying to predict loan amount? You can predict that. I don't think that makes any sense, really. You're trying to predict the default, right? Like you can predict any of these features over here. You can try to predict the credit score. I guess that could kind of make sense, but these things are given to us, right? So you're trying to predict, will the loan be defaulted or paid off? That's what we're trying to get at here. So we set up the model, trained and tested it, and so that was good. This model is 0.99. So I trained and tested the model. I can use this to make predictions if I add in features, and the feature looks basically like this. Credit score is 712, debt to income ratio is that, loan amount, and so on and so forth. I can be pretty guaranteed, pretty sure, pretty certain, whatever, that the loan will not default. This is going to be a 0. A 1 would be yes, 0 is no. So all these loans are not going to be defaulted on if it matches these inputs over here, right? So that is what the model is being trained and tested on, and it's making 99% accurate predictions, right? So let's look at another scenario down here. Control Enter, and I'll share all this code with you, okay? So you don't have to go through and make notes and try to understand everything comprehensively. When I post the video, I'll post all the source code so you can copy and paste it and run it in your own environment and see exactly what this is doing, step by step, line by line, right? So here, we just trained and tested the model. Now we're going to look at a slightly different scenario here where we have unemployment rates, GDP growth. So this is a macro factor, interest rates, right? And average default probability. So again, like we saw before over here, you have these inputs. Oh, shoot. Oh, trying to do too many things here. And wait, there were some changes. Let me cancel it. Let me save it. Sorry, guys. Let me save it. Okay, 2 seconds ago. Now it's saved. Now I can refresh it. I don't think there's any major change, but let me refresh it here. I think this computer is a little bit old and it gets a little bit low on memory. Alzheimer's is coming in or something. So debt to income ratio. So these are the features that we're looking at, right? And we're trying to predict the default. So in this scenario, it's a little bit different. We have these macro factors, macroeconomics, right? Unemployment, GDP, interest rate. Now, what's the average default probability? So if this is the unemployment, GDP growth, and interest rates, again, we can make predictions about the default. This is 2%, this is 1%, 1, this is less than 1, right? So given these factors, we can try to predict what is the probability of a loan being defaulted on in these macroeconomic scenarios, right? So let's go ahead and create a chart. I always say a picture is worth 1,000 words. Let me visually represent what's going on here and understand in this 3D graph, in this 3D graph here, what we're looking at. So if I spin this around with you a little bit, you can see GDP growth on the x-axis, interest rate is on the y-axis, right? So you have the horizontal, that's the x, the y is the vertical, and the z would be the unemployment rate. So most of these are saying average default probability very, very low, less than 1%, a fraction of 1%. Although this one over here in the yellow is high, you can see that this has the highest probability of default, and it's still kind of low, like 0.019, close to 2% chance of default. And that's when the GDP growth is actually negative, right? So GDP, the growth domestic product for this country is negative. That's telling me the economy is tanking, unemployment is spiking up, interest rates are high. You can see literally interest rates are almost 6%, 5.9%. Then the average default probability is going to be higher, right? Like if you have all of these economic hurricanes going on, high unemployment, high interest rates, um, GDP is in the toilet, right? Like all these horrible things are happening. Yeah, you're going to have higher probability of default. Down here in this scenario, unemployment is relatively low. GDP is positive 4.8%, and interest rates are low 1.0%. That's not realistic in this environment. Right now, it's May 2025, so interest rates are much higher now. But look at this scenario: if interest rates are low, GDP is high, unemployment is relatively low, 5.2% is relatively low. Average default probability is a fraction, tiny fraction of 1%, like 0.0005039, right? So if all these economic scenarios are healthy and positive, the chance of a default for the money that you're lending from your financial institution, whether you're a bank or a fintech startup or a credit lender or whatever, chance of default is very low. But if the economic scenario is very different, the GDP is high, unemployment is high, interest rates are high, that's a recipe for disaster, right? And there's probably going to be more um, chances of the loan not being paid off. So let me go down here and look at a feature importance chart. So feature importance shows you which features have the most impact on the target variable. So remember, we said over here, if I go back a little bit, the target over here is the Y variable, right? I've got several videos on my channel. If you want to learn more about machine learning and data science, definitely check those out. It's very enriching. It's very empowering, I think. So the target variable is what we're trying to predict, and the X variable, or the independent variable, is all the features that we're trying to use to make that prediction, right? So over here we have all the features. It's credit score, debt to income, loan amount, unemployment rate, GDP growth, and interest rate. We're using all these macroeconomic features to try to predict the probability of default. And it's abbreviated PD, probability of default. So these features down here have the highest impact on the probability of default. So credit score, if you have a low credit score, you probably will default. If you have a high credit score, you probably won't. The loan amount has 19% influence. This is 21% of the time of a default. It's triggered by credit score, right? Bad credit score. If you loan too much money to a guy or girl with low credit score, that's your fault. That's your problem. That's your mistake. You have to eat it, right? And there's going to be a default probably. And the loan amount. So if you have a bad credit score and you make a huge loan to some person, then I mean, what did you think was going to happen, right? Like these things. You have to look at um, these features and understand these features, and you'll be successful. If you don't understand what this is, then you're not going to be successful, right? There's an old saying, a fool and his money are soon parted. If you're a fool and you know there's a low credit score and you give a huge amount of a loan to a person and the debt to income ratio is high and the unemployment rate is high, if this person's unemployed and the GDP is high and the interest rates are high, this is what we saw in 2008, right? Like these people weren't looking at these features and weren't looking at this comprehensively. That's why we got into trouble that we got into, right? So these features have the highest impact on a loan being defaulted, right? So credit score, loan amount, and this is a percentage of the influence for the target variable. So 21%, 19, 18, 16, 12, and 12%, right? And if we look at this from a cumulative perspective, how do we get to 100% and how these all add in together? Because if you add 21, 19, 18, 16, 12, and 12, you get up to 100%. There's some decimal places over there too. But this is a cumulative effect of all of these features having an impact on the probability of a loan being defaulted, right? So credit score, loan amount, debt to income ratio, unemployment rate, GDP growth, and interest rate. So hopefully that makes sense. I tried to explain it in a way that's I can break it down fundamentally and explain what's going on here. And if you want to understand and predict the potential for a default on the loan, this is how you would do it. Okay, this is how they should have been doing it in 2008. They didn't really um, do this kind of stuff. I mean, I know that was a long time ago, and technology is very superior now to what it was about what was that 17 years ago, I think, give or take. Um, anyways, this is how it should have been done. It wasn't really done that way, and that's why these two behemoth banks, Lehman and Bear, got into trouble. So hopefully we're smarter and wiser, and we can intervene and prevent this kind of catastrophe from occurring again. So that's it, predicting potential loan defaults. And hopefully this was educational and motivational for you. I like to drop knowledge and share my findings. I've done this work before. I put this together a couple days ago, and I wanted to share it with you guys now. So hopefully that was good use of your time. Thank you so much for showing up today and for seeing this thing all the way to the end. And I will see you in the next video. Goodbye for now.